Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated, her website jugglingdynamite.com. Welcome back to the show, Danielle.
Thanks, Jim.
Danielle, are people who hope to invest in real estate in for tough times?
No, I think the ones who are waiting to invest in real estate are probably in for better times ahead. It's the ones who have been doing it in a highly levered fashion over the past few years that I think are in for a troubled patch. Indeed, with the low rate environment that we've seen since the last recession, of course, rates have fallen for the last 10 years, basically, in fits and starts. And during that low yield period, people were looking for other, non-conventional sources of income. And so what they did was they decided that real estate was it. So we saw this massive investment at every level, institutional, pensions, individuals. Because you could borrow money cheap, they went into doubling down on this space, and that included, institutional living, whether it was condos, seniors' homes, dormitories for students, and of course all the commercial and retail space that went along with those planning groups. And so it was really dramatically overbuilt, that sector, way before the pandemic hit. And then what's happened, of course, is that we've got this abrupt migration now from the highly dense cities and places in all over the world, but in North America in particular, you're seeing this migration out of things like condos. Now, condos were the cheap go-to, right, because prices got so overvalued and impossible for people to afford relative to incomes and rents. So what happened was there was this, let's build more condos. So Toronto, for example, was just, a massive overbuild of this type of property. And indeed, those are the kinds that are now seeing a lot of vacancies as people look for properties that they can live in that have more space, that are outside of urban areas or a little more space around them, that sort of thing. So you've really got a whole bunch of negative feedback loops now, because the data shows that the number of listings of condominium properties in big centers have just gone through the roof, like quadrupled in the last year, for example, in places like Toronto. And then rents are following, right? Rents, if you have that many properties available and vacancies are leaping, then you see that prices are now following. So rents are down 15 to 20% in cities like New York and San Francisco. In Vancouver, I saw condo rental prices are down about 17% in the third quarter. Toronto, about the same. So what this really tells you is that price then follows. And we're seeing that already in places like Manhattan, for example, where some of the high-end condo prices have fallen about 40% already in the last, say 8 months. And Manhattan home sales, in the second quarter, the home sales in general were down 56%. So there's that evidence of people looking to move out of the high dense areas into more suburban. And then, yes, we've had this big jump in the price of single family homes. The average single family home in September in Canada reached $600,000. This is an all-time record on all-time record sales for September. But my concern is, and again, rates are really low, so people think, we can take on an extra $100 or $2,000 or $3,000 of debt in order to get into this space where we'll feel safer and have more area for various family members to come back and work from home or study from home, that sort of thing. But the longer term effect of that is that they will have that much debt for that much longer, right? So it's not just a function of the ability to service the debt monthly, which is questionable if people start losing jobs more going forward, but even the ones who keep their jobs, right, even if rates stay low, the fact is they've now indebted themselves for a few more decades, and that impacts their ability to save for other things like retirement or any other need or rainy day that event that may come up. So it's really made the system more fragile. Even, the businesses that have survived in the last 6 months through the first close down in the economy, the vast majority of businesses report that they've added a lot of debt to do that, right? And now we're into this second wave, which is the most cases we've seen in Canada and other places, a big surge going into the winter, and a lot of the job losses that we've seen are going to be permanent. So really, I think it's a feedback loop here where we saw this massive overbuild in all this real estate. We saw a doubling down of private equity and funds and ETFs and all sorts of stuff, both on the REIT side, where they were collecting income from these properties, and on the securitized debt front, where a lot of mortgages were put into different kinds of securities and packaged and sold to investors when they were just, desperate for any kind of yield. And this kind of price indiscriminate buying is typically a very negative thing, because now that the defaults are rising, that rents are plunging, many of the properties that people were buying in the big cities like Toronto and Vancouver, in some of these really expensive properties that they were trying to rent out in the last few years, were actually cash flow negative or barely positive even before we saw any drop in rents. So all of these factors suggest that we're going to see further downside in price, and so far it's showing up in the condo space, but I think that could be the canary in the coal mine, so to speak, because it is an entry-level property type, and once you get a drop in demand for that level, it sort of sets the bar for the market in general, and the move-up potential of some people will be diminished if they can't, sell a condo for anything like what they expected or need to try and, cross that void now to get to the single family property. So we've seen this type of cycle before, and I was writing on the blog about, Thomas Piketty's book is very excellent on this topic, Capital and Ideology, because it talks about all the various times in history where you had very wealthy pockets of society get insanely more wealthy relative to the average worker, and how they were then building all these mansions. And what ends up happening is at the end of when the boom goes bust, so to speak, the mansions are too expensive to maintain, and people start saying, how are we going to pay the taxes? How are we going to have staff to help us with all the upkeep and maintenance on this? And then they look to turn those mansions into multiple-use housing again. And this is ultimately a very positive thing, because neighborhoods where regular people were priced out, and we've seen that in lots of areas in Canada where working people couldn't possibly afford the rent, never mind, the trying to buy it. And so they were really marginalized or sent to condo living as the only option. And when the large single-family homes get reconfigured back to multiple apartments or condos or townhouses, making them into more than one family home, you're going to get this ability of prices to come down. This is all very positive for people who are looking to rent, because they'll get, be able to have more to pick from in nicer areas, and we'll get more migration back after the pandemic. But ultimately, I think between now and then, it could be quite a gap, and there's going to be a lot more pressure intensifying on, as I say, the very highly levered people who are both investing in this space and also who have reached for more house than they can afford.
We'll have more with Danielle Park right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. surrounded by world-class gold deposits and mines. Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Danielle Park. Danielle, one of the major organizations in the world, OECD, is predicting most economies will remain below their 2019 output levels through next year. The only country that's expected to see a gain, 10%, is China. Why does China have a brighter picture than the rest of the world?
Well, partly it's because they clamped down so hard when they went into the pandemic, and they were first in and sort of first out of the worst of it. They adapted very quickly. They have a culture of wearing masks and social distancing. They've had a lot of experience with viruses over the years. They adapted fairly quickly. But also they have, social planning from the government top down, and they sort of make their own numbers a lot of the time too. So their reports are always in a world of their own, so to speak. But I think that the theme here, whether it was the IMF this week also came out with their forecasts where, they increased slightly their expectation for growth in 2020 from their previous forecast in June, but they downshifted in terms of what they expect to see in 2021. So this theme again, which I've mentioned before, which was over-optimism about how quickly this pandemic would pass and how quickly things would, quote, get back to normal. And what we're seeing is that the growth trajectories have come down so significantly, as I've mentioned before, the worst recession since the 1930s, but also we know that people have been, putting people back to work is much harder than laying them off in the first place. And so the economy is going to continue to struggle. The behavior shifts that I'm talking about here of consolidating households where, multi-generations are going into one place and saving overhead costs and that sort of thing, spending less, not eating out, not commuting, all this stuff, not going to, downtown, restaurants, bars, businesses, all the stuff that was small business drivers of the economy. Those are not coming back anytime soon. We're still seeing a fraction of the people. It's amazing in places like London or San Francisco or Toronto or New York. You've still got 10 to 15% of the population of workers who normally would be in that area. Only about 10 to 15% there. So the bulk of people are still working remotely or from some other area and spending a lot less in doing so. So these are behavioral shifts that are going to be sticky, and it won't be a quick bounce back. And as I've mentioned before, many of the businesses, the larger businesses, have said, we're going to continue to migrate to this remote work scenario, especially in the big sectors like tech and finance, which have a lot of flexibility around doing that, and they've been sort of the majority of renters in these, commercial spaces in large cities. So these shifts that are taking place are massive, and they're going to continue for a good period of time, probably measured in years. And that means that the economic numbers, the way we count GDP and output that we saw in 2019 is likely to be the top of what's going on for quite some time. Now, what needs to happen is a shift. If you think about, for example, Canada, how we've generated the bulk of our gross domestic product in the past decade has been from the oil and gas industry, from auto manufacturing, and from the real estate sector, and primarily from the real estate sector, right? And again, not because we're making homes super efficient and, retrofitting them with new technology and the latest in renewable energy and all these things that would make homes less expensive over the next decade. If we'd done all that, if that's where the investment had gone, then you would get a lasting benefit. But instead what we've done is we've doubled down on just old tech housing, right, which is, as I said, very inflated in price and reduces people's ability to spend on anything else. So we have not got any lasting efficiency benefit. We've got less productive in this process. So what we really need to do now is think about new business models. So this means, migrating workers that have been displaced by the shift that's going on in the world. When the major oil companies, for example, are talking about, and the IEA and all these institutions are lowering their forecast of their expectation of global demand for things like the oil and gas sector, and you've got, lost jobs left and right, you really need to figure out how can we start making more domestic production in things that will be a lasting boom and are not on their way out, are on their ascendancy and will add to efficiency. So this is things like, developing battery technology, developing alternative energy, developing electric cars. Windsor just got a new deal last night. The union and Fiat Chrysler came to a deal where they're going to invest a couple of $2 billion back in that community to build to build another line of vehicles because they recently lost a lot of jobs there, and they are going to be hybrid and electric vehicles. And that's expected to put 2,000 people or new jobs back in the community in the next couple of years. So there's an example. We are extremely capable and excellent at auto parts and manufacturing in Canada, but we don't actually have any Canadian vehicles or any Canadian electric vehicle. So there's an area where the world is moving towards where there's huge demand and opportunity, and those are the kinds of things that Canada has to think about. Instead of just building more condo boxes that nobody's going to want, we need to think about how can we make more efficient housing? How can we, retrofit some of these large spaces? How can we reclaim some of this extra retail space, which we have now built in gut across the country? And we're going to have to figure out new uses for that space. So there's going to be bankruptcies in this process. There's going to be price write-downs of the cost. There's going to be lost sunk costs. But all this has to happen because the system has become so incredibly top-heavy and inefficient. And we're going to there'll be a creative destruction in this process where we get new ideas and innovation and ways to make money, new business models, and that's all very positive. But it's the downside for the present holders where the pain is really going to be felt.
We'll have more with Danielle Park right after this.
Value from success, growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, on your blog, I saw a little note that said, Avenge of the Avro Arrow. What's that all about? And for people who don't know what the Avro Arrow was, Canada, back in the Diefenbaker days, developed the world's most advanced fighter jet. Interceptor. It was faster, could fly higher, and had a better weapon system. And the U.S. said, if you start selling that to the world, we'll have a major trade war and we'll bring you to your knees. So we scrapped it. And all the people who worked on that project, most of them ended up working on Apollo and sending Americans to the moon. A third of the people who worked on Apollo were Canadians. And I know that for a fact because a friend of mine's father worked on the Avro Arrow, and the day after he was laid off, he got a call from NASA about working about the moon project. So what is this Avenge of the Avro Arrow all about?
Well, it's just trying to get people's minds and creative interests focused on things like developing an all-Canadian electric vehicle. So this is the president of the Auto Parts Manufacturing Association in Canada. They were basically doing a contest or a shout out to get university students to go into a design competition and come up with a design for a compact SUV that's all electric and could be built in Canada. So it's, again, just trying to show that, we have all this excellent expertise. We're world leaders in terms of manufacturing and auto parts. And why don't we start thinking outside the box in terms of developing more of our own domestic product instead of just working for large multinationals that, are making the same old ICE engines, which are no longer, which are on their way out. So it's a question of trying to think big, have grand design ideas, moonshot type style, which is how we'll get new ideas. And we need more investment and attention in those innovative areas. And a lot of the young people that are coming out of our educational institutions really get this, and they have the ideas and the energy to drive this thing forward. So we need to marry the investment, the government incentives, and along with the entrepreneurs and the innovative technology and thinking so that we get these new ideas off the ground. So it's just it's always, we've sort of been through this period the last 20 years where we've sort of slumped back onto the, selling of rocks and trees, manufacturing ICE cars, and as I say, doubling down on real estate. We've really come to the end of those themes. And as we transition here, we have to replace what's leaving or the business that's going and the GDP that's no more with new ways to feed ourselves, basically. At the same time, you have to do more domestic production. A lot of the jobs that were pushed off to Asia and cheaper labor pools, we paid the price in the sense of stagnant wages and debt load and weight, which is now very prevalent in Canada and many countries. So in order to bring jobs back, we have to bring domestic production of goods back as well. And there's lots of different areas where we have to think about how to do that.
Do we need to change the tax regime for investment into capital projects so that Canadians are encouraged to put their money into Canadian things instead of looking at the U.S. stock market?
Well, we used to have things like venture capital funds in Canada. I remember, 20 years ago where you would put in money there and there was a extra large tax credit. Unfortunately, most of those ended up being terrible investments for people, extremely high fee internally, and although they got the tax break up front, the securities themselves became defunct or went to zero. So we have to be very careful at how we do it. I think that there are obvious there are some things like, for example, we have to start taxing capital and dividends the same as we tax labor. I really think we have to, maybe we have a flat tax across the board, but as I've mentioned in the past, we have a lot of investment needed as well as a lot of debt that needs to be repaid. So we have to get revenue from somewhere. So this means that we have to think about, how can we make large corporations pay more, of their share if they're going to be producing goods, and also how do we encourage the innovation stuff. So it's a tricky business, and there needs to be a lot of thought about it. But we do have a lot of historical precedents for things that have worked in the past, and certainly government is really good at the infrastructure stuff, partnering with it, and driving that sort of thing that will benefit everyone in terms of, whether it's water systems, whether it's electrical systems, whether it's roads, waste processing, all that stuff. That's really where the taxpayer dollars get the biggest bang for the buck. And again, it's about spending today in an investment sense so that we have an advantage of lower costs and less waste going forward. And in a world where all the, shiny things the retail, the superfluous, the discretionary spending, the services. That's one of the disadvantages of this past couple of decades is the more manufacturing left domestically and went elsewhere, the more we became focused on just services. Well, services are one of the things that's the most vulnerable in not just the pandemic, but also in a credit bust where people get more frugal. And that's what's happening, right? They're deciding, hey, we don't have to go to the mall and put on fake nails every day. Hey, we don't have to, eat out constantly. And this sort of revelation is something that, as I say, is sticky, lasting. It's interesting even that in the polls recently that were done on retired people, we're saying that, the vast majority of them are rethinking their retirement plans in terms of their retirement living, where they expect to be. And this is, again, something where we've had a big build-out of institutional offerings on retirement living, but now there's more people wanting to stay in their house or move in with family in order to keep costs down, but also to protect them from, mass living quarters where things like viruses can spread. So everything's kind of in the midst of a flux at the moment, and that's why everything, that sort of was tried and true in the past, we have to be very careful that we don't just presume that that's going to be the engines going forward, because that's very unlikely to be the case.
Danielle, as always, a great report, and we look forward to our next one.
Thanks, Tim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. She's the president of Venable Park Investment Council Incorporated. Her website is jugglingdynamite.com. If you have any questions for Danielle or any of our other guests, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HouseStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.